Welcome to Griffonomics.
Glad to be here for this one.
I am so thrilled to welcome you to a brand new deep dive. Today we are pointing our lens at a company that you probably aren't going to hear about at your typical neighborhood barbecue.
No, you definitely are not.
Right. But they are operating right at this incredible intersection of public safety, global defense, and believe it or not, the artificial intelligence revolution. The company is Cadre Holdings, trading under the ticker CDRE.
And that is exactly the kind of hidden in plain sight business we love to analyze.
It really is.
To really figure out what is happening under the hood here, we have pulled together a massive stack of sources for you. We are going through their recent SEC filings, the earnings call transcripts from March 2026, their latest press releases, and some incredibly detailed Investor Day presentations.
And the mission for today's deep dive is to map out Cadre's fundamental transformation. We are looking at how a company that historically was known mostly as a domestic supplier of police gear is rapidly evolving into a highly diversified global safety platform.
Yeah, to execute that mission, we are going to break down the three key pillars emerging from the source material. First, we need to look at their highly strategic acquisition of TYR Tactical.
A huge move.
Massive. Second, we're going to explore their follow the fuel strategy in the nuclear space, which is just a fascinating pivot. And third, we will analyze what it actually means for their financial health, that they are sitting on a massive, record-breaking backlog approaching $190 million.
Okay, let's unpack this, starting with the core business model itself, because you have to understand where they came from to really understand where they were going.
Right, you need that foundation.
Exactly. Cadre essentially operates on an 80-20 split. The product segment is the heavy lifter, driving roughly 80% of their total revenue. This is their proprietary manufacturing arm. We are talking about the Safariland brand, which makes body armor and duty gear, and Medang, which manufactures explosive ordnance disposal or EOD bomb suits.
Right, and then you have the distribution segment making up the remaining 20%. Think of this as a highly specialized one-stop shop for law enforcement agencies.
They sell their own gear, right?
They sell their own proprietary gear, but they also distribute third-party items. We are talking uniforms, boots, optics, firearms, you name it.
And from a pure business perspective, why bother with the 20% distribution if manufacturing is the main event? I mean, why not just focus on the high-margin products?
What's fascinating here is the incredibly defensive moat this creates. By being a one-stop shop, they create these recurring, sticky touch points with agencies.
Oh, I see.
Yeah, if a police department knows they can buy their body armor, their radios, and their boots all on one invoice from Cadre, it captures a massive share of that department's wallet. It builds tremendous brand loyalty over time.
So it feeds the manufacturing side.
Exactly. But the real magic of this business model lies in the product segment itself, because it is not a highly cyclical business that ebbs and flows with the broader economy.
Meaning they don't have to worry as much about a recession hitting their bottom line.
Precisely. Over 60% of their product sales are explicitly tied to mandated 5 to 10-year refresh cycles.
Wow, 60%.
Yes. When you are dealing with mission-critical, life-saving gear, you don't wait until it falls apart to buy a new one. Customary warranties and stringent government safety standards force these agencies to replace this equipment on a very strict, legally mandated schedule. That gives Cadre an incredibly predictable, acyclical revenue floor.
Because, let's face it, if your job is walking up to a literal explosive device, you aren't going to wear a bomb suit that's past its expiration date just to save the department a few bucks.
No, absolutely not. You are fulfilling non-discretionary safety budgets. The money just has to be spent.
But they aren't just sitting back and waiting for those refresh cycles to roll around, are they? They are actively driving demand through what they call the COM engine, the Cadre operating model.
Right. The sources describe this as their internal philosophy for continuous innovation and operational efficiency.
You see this vividly in their recent product wins. For example, they just launched the Safariland SXHP. According to the engineering specs in the filings, this is the thinnest and lightest hybrid armor ever developed.
And we shouldn't gloss over why that matters. If you are a patrol officer wearing this gear for a 12-hour shift in the middle of summer, every single ounce matters. Shaving off weight while actually increasing the ballistic protection is a massive technological leap. It forces departments to want to upgrade earlier.
The innovation extends well beyond standard body armor, too. Let's look at that Medang division we mentioned. In the EOD space, Medang is essentially the Kleenex of bomb suits. They hold an estimated 80 to 90% global market share.
That is a staggering monopoly on a niche market.
It is. But what the comm engine is doing is leveraging that deep expertise in blast physics and applying it to entirely new, adjacent defense markets.
And this is where we start seeing some really impressive numbers. They recently secured a $50 million IDIQ contract from the Department of War for the Blast Exposure Monitoring System, or BEMS.
And for anyone who doesn't speak government procurement, IDIQ stands for Indefinite Delivery, Indefinite Quantity, right?
Correct. It basically means the government has pre-approved them for a massive open-ended tab up to $50 million.
And the BEMS technology itself is just amazing. They aren't just selling heavy armor anymore. They are providing highly sophisticated sensor hardware and software.
Yeah, these sensors are worn by service members during training to track blast overpressure exposures over time.
It is entirely focused on protecting brain health and preventing traumatic brain injuries, which has become a massive priority for the military. And the filings show deliveries for those sensors kick off in 2026.
Right on the heels of that sensor contract, Medang locked down another $86 million in contracts from General Dynamics European Land Systems.
More blast protection.
Exactly. Cadre is going to be supplying highly engineered blast attenuation seats for military vehicles. These are specialized seats designed to absorb the shock of mine and roadside explosive threats, protecting the occupants. And that production run stretches from 2026 all the way through 2031.
Having guaranteed production running into the next decade provides immense revenue visibility. So we know the products are saving lives and expanding into new markets. But how does all of this innovation actually translate to the balance sheet? Let's dig into the financial realities and their full year 2025 review.
The numbers across the board broke records. For the full year 2025, Cadre generated total net sales of $610.3 million.
Which is a 7.5% increase year over year.
Right. That growth was driven heavily by global demand for their core duty gear, as well as the successful integration of a previous acquisition called Zircaloy. But top-line revenue is only half the story.
Right, because making money is great, but keeping it is better. How did their profitability hold up?
Incredibly well. Cadre achieved their third consecutive year of record-adjusted EBITDA, hitting $111.7 million.
Which represents an 18.3% margin.
A very healthy 18.3% margin. But if you really want to see the strength of their operating model, look at their gross margins. For the full year, gross margins expanded by 140 basis points to reach 42.5%.
Okay, 140 basis points might just sound like financial jargon to some. Why is that specific number such a big deal for them in 2025?
To put that in perspective, 2025 was a year where a lot of manufacturing companies were getting absolutely crushed by labor shortages, overhead inflation, and supply chain costs. Their profit margins were shrinking across the board.
But Cadre went the other way.
Cadre actually widened their profit margins by 1.4%. That's what 140 basis points means. Achieving that in an inflationary environment is a true testament to their pricing power. Because they sell absolute necessities, not nice-to-haves, they can pass those increased costs along to the customer without destroying demand.
And they are making sure to return that capital to you, the shareholder, too.
Yeah.
In early 2026, they announced a 5.3% bump to their annualized dividend, bringing it to 40 cents per share. This actually marks their 17th consecutive quarterly dividend since going public.
Financial discipline like that is exactly what gives a company the war chest to go shopping. And in January 2026, they went shopping for a major player in the armor space.
Which brings us to the monumental M&A deal they closed, the acquisition of TYR Tactical. Cadre acquired TYR for approximately $174 million.
And the filings showed the purchase price was structured smartly, too. It was $150 million in cash, $24 million in Cadre common stock, plus some restricted stock units and potential earnouts if TYR hits certain future revenue targets.
The strategic rationale behind this acquisition is profound. TYR Tactical brings absolute world-class engineering capabilities, particularly in the realm of hard armor and advanced tactical vests.
They are highly respected in elite military circles.
But I have to ask, from a business perspective, if Safariland is already the dominant player in the body armor market, isn't spending $174 million on TYR just buying your own competitor and cannibalizing your own market share?
It's a great question, but that is exactly why this deal is so brilliant. It is a massive geographic and demographic play. Safariland has a huge footprint with U.S. state and local law enforcement agencies. TYR, on the other hand, generates 66% of its revenue from international markets.
So they are buying a passport into new territories.
Exactly. This acquisition grants Cadre immediate, deep entry into European defense markets like Denmark and North American markets like Canada. And the beauty of this deal is that the filings show there is virtually zero customer overlap between TYR and Cadre's existing Safariland business.
Zero overlap.
Virtually none. They are acquiring entirely new networks of elite defense and international law enforcement clients.
And the financial impact of plugging TYR into the Cadre machine is expected to be immediate. According to the investor presentations, TYR generated $93 million in revenue in 2024. Cadre expects this deal to be immediately accretive to both earnings and adjusted EBITDA margins.
And just to clarify that term, when a company says an acquisition is accretive to EBITDA margins, it simply means that from day one, the new business is so profitable that it actually drags the average profit margin of the entire parent company upwards, rather than weighing it down.
They've conservatively modeled TYR to contribute around 20% EBITDA margin for 2026.
Right, so they take a high-margin, mission-critical business, plug it into the comm engine, strip out the back office inefficiencies, and cross-sell their expanded portfolio globally. It makes total sense.
It really does.
Yeah.
But as transformative as the TYR deal is for their core public safety segment, their moves in the nuclear space represent an entirely different scale of ambition.
If we connect this to the bigger picture, this is where the entire narrative of Cadre Holdings shifts from being a traditional defense contractor to something much more foundational to the future economy.
Here's where it gets really interesting. I want you to pause for a second and ask yourself, how does a company famous for making police holsters and explosive ordnance suits fit into the global artificial intelligence revolution?
It sounds like a massive stretch.
It does, but Cadre is positioning itself right at the epicenter of the AI boom.
It all comes down to energy infrastructure. The massive hyperscale data centers required to train and run next-generation AI models demand surging amounts of electricity. The grid simply cannot support this computing power with traditional renewables like wind and solar alone. They need reliable 147 baseload power.
Which leads us to nuclear.
Yes. This realization has triggered a seismic shift in policy, with government mandates aiming to quadruple United States nuclear power generation by the year 2050.
And looking strictly at the financial impact of these policies, regardless of where anyone stands on the politics of energy mandates or defense spending, and just to be absolutely clear, we are strictly looking at the facts laid out in the filings, taking no political stance. This creates a massive tidal wave of capital.
Absolutely. We are just following the facts. And from a pure business analysis standpoint, this is a monumental shift. For decades, the U.S. nuclear supply chain was essentially dormant. Now, there is a frantic race to build new commercial plants, and Cadre is capitalizing on this through a pivot they are calling their follow the fuel strategy.
Follow the fuel is the perfect name for it. Cadre isn't out there trying to build the nuclear reactors themselves. They are providing the critical safety infrastructure that makes the entire nuclear fuel cycle possible in the first place.
Through this segment, they are targeting a total addressable market, or TAM, of $3 billion to $6 billion. This spans across environmental cleanup of legacy sites, weapons modernization programs, and the rapidly expanding commercial nuclear energy sector.
To give you an idea of what that actually looks like on the ground, let's look at one of their flagship products, the SAV-Y400 container. This isn't just some heavy-duty metal bucket. It is a highly engineered, rigorously tested container that is uniquely certified by the Department of Energy for handling, transporting, and storing highly specific nuclear materials.
And the barrier to entry there is astronomical. You cannot just spin up a startup and start selling nuclear containers to the government tomorrow. The certification process takes years.
Cadre also builds specialized nuclear ventilation systems and criticality alarm systems.
Right. As the nation scrambles to fuel this commercial nuclear renaissance, they literally cannot move the materials safely without this equipment. Cadre is standing right at the bottleneck, providing the mandatory safety gear.
It is brilliant positioning. But as with any company operating in highly regulated spaces, it's not all smooth sailing. We have to look at the market skepticism. What are the actual risks to this follow-the-fuel strategy and the broader business?
This raises an important question because while the long-term tailwinds for nuclear energy are incredibly strong, operating as a government contractor comes with significant near-term volatility. The first major hurdle outlined in their financial disclosures is a near-term revenue mix headwind in their nuclear segment.
And this is tied directly to a recent shift in government priorities regarding the U.S. plutonium stockpile.
Right? The filings mention a shift away from downblending and toward pit production.
For those of us who aren't nuclear physicists, what does that actually mean for Cadre's bottom line? Again, keeping it strictly to the reported facts.
Of course. Downblending is essentially the process of taking highly enriched nuclear material and diluting it down so it can be disposed of safely. Pit production is the manufacturing of the plutonium cores for new weapons. Recently, an executive order effectively slowed down the downblending program to redirect resources toward pit production.
And Cadre historically provided very high-margin containers specifically for that downblending process.
Exactly. So while Cadre is still selling equipment for the new pit production facilities, the sudden drop in demand for their highly profitable downblending containers creates a negative mix shift. It means that, for the short term, the profit margins in their nuclear segment are going to be squeezed as they adjust to the government's new timeline.
Another critical risk we found buried in the filings revolves around their manufacturing supply chain. Cadre manufactures high-end ballistic garments. That means they rely heavily on very specific, limited-source raw materials like Kevlar and SpectraShield.
Because these materials are so specialized, any disruption from the supplier side immediately throttles Cadre's manufacturing capabilities. They can't just switch to a different fabric overnight.
And that supplier risk is significantly magnified by the regulatory environment they operate in.
Right. Under the Defense Production Act, or DPA, the United States government has the authority to force suppliers to prioritize rated government defense orders above all other commercial contracts.
Meaning they're essentially at the mercy of national defense priorities. If the government invokes the DPA and needs all the Kevlar, Cadre's police distribution segment just has to wait.
Exactly. It can cause sudden material shortages for their commercial lines.
Finally, we need to talk about a significant corporate governance risk regarding insider control. The SEC filings detail that CEO Warren Kanders and other corporate insiders beneficially own approximately 59.5% of the entire company.
For you, the everyday investor, that level of insider concentration is crucial to understand. It means the executive team wields massive, unilateral influence over all corporate matters. With nearly 60% of the voting power, they can dictate strategic direction entirely.
Which also means they can block a buyout.
Precisely. They can block any potential takeover bids. Even if a larger tech or defense giant swooped in tomorrow and offered a massive premium to buy Cadre, Warren Kanders can simply say no. When you buy shares of Cadre, you are very much locking yourself into management's specific vision for the future.
So what does this all mean for the listener? When we take the $190 million record backlog, this highly strategic TYR tactical acquisition, the massive ambition of the nuclear follow-the-fuel strategy, and weigh them all against these margin pressures and supply chain risks, where does that actually leave us?
Synthesizing the data across all of our sources, the overarching outlook rates Cadre Holdings as a bullish or hold-on weakness play. Yes, the near-term nuclear mix shift and potential supply chain hiccups might cause some quarterly margin fluctuations. But you have to look at the foundation. The fundamental nature of their business is incredibly defensive.
It all comes back to that moat.
It does.
Yeah.
Those legally mandated 5 to 10-year refresh cycles for life-saving safety gear provide a highly acyclical, predictable floor. Cadre isn't out there chasing consumer fads. They are fulfilling non-discretionary safety budgets that have to be spent. That dynamic positions Cadre as a resilient, long-term compounder of capital.
It really is a masterclass in building a mission-critical moat. And it leaves us with a final provocative thought to chew on as we wrap up. As the global push for AI computing supremacy forces this massive, undeniable nuclear energy renaissance, will the broader market eventually stop viewing companies like Cadre purely as traditional law enforcement suppliers? If their nuclear containment and defense technology become the absolute mandated bottleneck for building our next-generation power grid, will they eventually be re-rated by Wall Street as a foundational energy infrastructure defense company? And if so, how does that shift fundamentally change the way we value safety technology in the future? It is definitely something you'll want to keep a close eye on as the AI and energy narratives continue to collide in the coming years.
Risk defined. Portfolio protected.